Of course, just like any businesses, House of Coffee does not just want to break even. They want a profit. The break-even point analysis in dollars and units gives us the minimum needed to cover costs only. But now that we know the formulas and tools to find what it takes to make sure our business does not have a loss, we can take that information and run with it. Why stop at break even when we can come up with a way for House of Coffee to make a profit? We can build off of the break even point formula and find their target profit level or target profit. When determining the target profit, House of Coffee must consider taxes. After all, taxes must be paid on profit, which in turn reduces the profit. First, House of Coffee should decide their pre-tax target profit. On the income statement, pre-tax target profit is labeled operating income because it is the income from business operations before deduction of interest and taxes. This target level of profit should be added to the fixed cost to calculate a new break-even point that includes the target profit. We can factor in the target profit into the break-even formulas that we just learned in units and also in dollars. Let's say House of Coffee has decided they want a pre-tax profit to be $3 million. So let's take a look at how we can factor this in the target profit to the break-even formulas. Let's start with pre-tax target profit formula in units. Pre-tax target profit plus fixed cost divided by contribution margin per unit equals target sales level in units. For House of Coffee's large cappuccino, it's $3 million plus $5 million divided by $4 equals to 2 million units must be sold to realize a pre-tax profit of $3 million. Now, let's look at pre-tax target profit formula in dollars. Remember, we found the contribution margin ratio for House of Coffee's large cappuccino with this formula. $4 contribution margin per unit divided by $7 sales price per unit equals 57% contribution margin ratio. Now that we know the contribution margin ratio, we can plug it into our new pre-tax target profit formula in dollars for the large cappuccino. Pre-tax target profit plus fixed costs divided by contribution margin ratio equals target sales revenue. So that's $3 million plus $5 million divided by 57%. That equals to $14 million in sales revenue that must be made to realize a pre-tax profit or operating income of $3 million. Again, we can confirm this looking at the contribution margin income statement for the large cappuccino with the 2 million unit sales level. The owner of House of Coffee knows that if he makes a profit of $3 million, he will have to pay income tax on that profit. After the tax rate is determined, applied, and paid, this reduces the operating income of the company. As a simple review for our purposes in this lesson, operating income less taxes is net income. So after-tax target profit is labeled net income on the income statement. The pre-tax target profit formulas ignore income taxes. So now let's factor in our real bottom line, the net income or operating income after income taxes. Don't worry, this is not so hard. Let me show you. All we need to do is to convert the after-tax target profit to pre-tax target profit to gross it up. It is the equivalent to taking the taxes you will need to pay and adding it back into your net income so we know how much we need to sell in dollars or units to reach our target net income.
Hello, certified professional. If you are enjoying this course, get accredited with CPE credits for watching it. Click the link in the show notes or visit cpeflow.com to access the full course ad-free and pass the final assessment quiz to officially earn your NASBA approved CPE credits and certificate of completion.
The after-tax target profit gross up formula is this. After-tax target profit divided by 1 less the tax rate equals pre-tax target profit. So we can find what our after-tax profit is in both units and also in dollars. Let's take this back to House of Coffee. The owner lets you know on their taxes. Their income tax rate is 25% and their after-tax target profit is $2,250,000. We use this information to plug into our after-tax target profit gross-up formula, which is $2,250,000 after-tax target profit divided by 1 minus the 25% tax rate, and that equals $3 million pre-tax target profit. By dividing our after-tax target profit, or the bottom line profit we really want to make, which is net income, and dividing it by 1 minus the tax rate, we gross up the target profit to pre-tax. So when the owner wants to know how many units does House of Coffee need to sell to reach their target after-tax profit, and what total sales revenue does House of Coffee need to reach their target, we are prepared to answer those questions. Now that we've factored in income tax and grossed up our net income to equal our operating income, we can use our familiar formulas to help out the owner. Let's begin with after-tax target profit formula in units first. Step number 1, $2,250,000 after-tax target profit divided by 1 minus the tax rate of 25% equals $3 million in pre-tax target profit. Step number 2, $3 million pre-tax target profit plus $5 million in fixed costs divided by $4. That will equal to 2 million units that must be sold to realize an after-tax profit of $2,250,000. Now, what is the after-tax target profit formula in dollars? Step 1, $2,250,000 after-tax target profit divided by 1 less the 25% tax rate equals $3 million pre-tax target profit. Step 2, $3 million pre-tax target profit plus $5 million in fixed costs divided by 57% contribution margin ratio. That equals to $14 million in sales revenue that must be made to realize an after-tax profit or net income of $2,250,000. One last look at this just in case you weren't convinced. We can see by the contribution margin income statement that at 2 million units sold, we have $14 million in sales revenue, $3 million in operating income, this is pre-tax profit, and $2,250,000 net income after tax profit. Thanks to factoring our target profits into our break-even analysis, we found the necessary sales in total revenues in dollars and units that we will need to sell to hit our target profits before and after tax. With these formulas, you can confidently inform the owner that in units, 2 million units of large cappuccinos need to be sold to realize an after-tax profit of $2,250,000. Now, what about in dollars? That is $14 million in sales revenue must be made to realize an after-tax profit or net income of $2,250,000. In the next module, which is our last of this course, we will take a look at 3 more concepts that will greatly help House of Coffee remain a prosperous business through a recession. These 3 concepts are called margin of safety, what-if analysis, and operating leverage. With these concepts, we dig a little deeper in the current picture of sales versus where the owner wishes sales were. We'll also look at changes in consumers' households that can impact House of Coffee's variables. So, are you ready to take this analysis to the next level? I'll see you in the next module.